Good morning, everyone. Welcome, and thank you for joining us for the Exact Accounting Maximising Profitability. Um, my name's Tracy. I am the Training Services Manager, and today I'll be hosting this webinar. Please be advised we are recording this session, and we'll be able to send the link out after the session has completed for you to sort of go back over it if you're interested. Today I'd like to introduce Gregory Khan. He is one of the client directors at Exact Accounting, and he's going to be presenting this webinar today. All right, Gregory, you're up.
I'll take myself off mute. All right. Can everyone hear me okay? Well, you're all muted. Okay, no worries.
We can hear
good.
You.
Okay. Yeah, look, I'm sorry, but I do have to look upwards. I've got a big TV here and it's it's got the presentation on it, so I won't be staring straight down the gun barrel. I do need to have a look at and follow this presentation through. So I'm just going to bring that up on my side. You guys should see the first slide. And yeah, thanks, Tracy. This is our maximising profitability, effective pricing strategies in the plumbing and gas industry. So we'll move to the next slide. This is just a quick brief about me. My name's Greg Khan. I'm a CPA accountant and a client director here at Exact Accounting. So Exact Accounting is Queensland's leading building and construction accounting firm. And our team are experts in dealing with QBCC related requirements. That's our tax and compliance team specifically. And I operate within the CFO advisory division. And what we do is we focus on clients and maximising their profitability and providing them with financial clarity, developing strategy, and ultimately improving shareholder value. So that's just a brief about us. What we're going to cover today, we're going to cover effective pricing strategies, determining your true cost of doing business, the old favourite, which is margin versus markup, fully loaded labour rates, fixed price models, and then to wrap it up, financial clarity and what sort of reporting you should have in your business. So that will be what we cover off over the next period of time. So just a little bit more about Exact. We're unique in a way to other accounting firms in that we have three different types of accountants here. Tax accountants, bookkeeping accountants who are specialists in the transactional world, and the CFO commercial accountants. So that's the division that I'm in. Our bookkeeping team specialise in transactional processing within MyOb, Xero, and QuickBooks. They also do payroll processing, job costing, project allocations, and then the preparation of weekly or monthly creditor payment summaries. And that team, there are about 16 bookkeepers, and they're all qualified accountants. So the compliance team are specialists in their field. They actually deal with income tax returns, deeds, BASs, tax planning, license disputes, audits, restructuring, and much, much more. In the CFO division, we are actually commercial accountants. So it's important to understand that there are three different types of people that work here. And these three services are services that we plug in with our clients, depending on their needs. But as for me, we come from an extensive background working within corporate businesses that cover off multiple industries. So we're not tax people. We're interested in your tax, but our main job is to drive profitability. Then we talk to the tax team about how we're going to save those things, because there's just so many rules and regulations in and around tax that you really, that needs to be your cup of tea and something that you love doing. And we've got a huge team here that do that. So I focus on financial clarity, profit maximisation, margins, estimates, budgets, cash flows, forecasts, liquidity, job costing, and that all leads to, more money in your pockets. So that's just a bit about our three different types of people that work in this business. Now let's have a look at the helicopter view of business stress. So this slide is showing the various types of stress you could be under when you're running a business. So stress can come from everywhere. All these factors need to be considered and managed. Having a commercial running mate such as a CFO helps keep the focus on your priorities. Early warning signs can be communicated and appropriate informed decisions can be made to address and resolve the multiple business stresses that you end up facing. Now, this next slide, I really like this quote. Uncertainty diminishes how efficiently and effectively we can prepare for the future, and thus it contributes to our anxiety. So, with so much outside of our control in that previous slide, this leads to a significant amount of uncertainty in the future. And the science is pretty clear on this, is that humans do not like uncertainty. So give me financial clarity any day of the week. The human brain is an anticipation machine, and making future is one of the most important things that it does. This quote means that the primary function of the human brain is to constantly predict and imagine future scenarios, essentially making the future in our minds rather than simply reacting to the present moment. It highlights our innate ability to anticipate and plan ahead based on past experiences and current information. So uncertainty diminishes how efficiently and effectively we can prepare for the future, and thus contributes to anxiety. So my question to you as business owners is, do you want to be anxious or actually know where you're going? Now, as an accounting and finance expert, I can help with reducing uncertainty in the financial health of your business. And that's what we're going to unpack for you all today. So many factors beyond your control and creating so much uncertainty, there is one aspect of your life and your business that you can demystify, and that is the financial health of your business. We call this financial clarity, which translates into certainty, predictability, known outcomes, accurate forecasting, whilst we also use detailed analysis and micro measurement. So financial clarity is a key for us and a key message that we deal with initially with our clients. Let's know what we're dealing with. What are our numbers? Are they accurate? Do they represent, properly in my business? Are they allocated in the correct general ledger accounts? Can I see my job profitability? What are my numbers? Can I rely on them? That's financial clarity. Now, some of you may have seen this before if you've seen other presentations, but I want to go through it. It's quite important. Now, what we're showing here is that COGS, or cost of goods sold, this will make or break you. So in this example, we're using a standard 20% gross margin, like you may see in the commercial sector. Margins in plumbing will depend upon whether you are doing residential maintenance, new custom work, new project work, commercial, industrial, or civil works. So for this explanation, because they are all so varied, I'm just going to use the 20% GP. So in here, we have 1 million in revenue coming through the business, as you can see on the left-hand side there. 800K of this is tied up in your cost of goods sold when you have a 20% gross margin. So needle movers come from a focus in the COGS area. So COGS are made up of direct costs of generating $1 in revenue. So items like materials, equipment hire, subcontractors, landscaping materials, leak detection costs, they're all going into your cost of goods sold. So with 80% of your expenses going into this area, it needs 80% of your effort to defend and protect your margin. So Here we also have 100K in overheads, leaving 100K in profit. So moving overheads down can have a minimal effect in your business if it's only 10% of your operation. So saving $100 on an electrical bill per month won't have anywhere near the impact of having a 5% movement in your gross profit. So that's important to keep in mind, that COGS area is a significant area requiring significant focus if you're to maintain or improve your margin. The next slide shows what pain looks like. So there's a 50K loss here. So what's happened is that we are now showing the impact of the gross margin coming down from 20%. So it was, I'm trying to move my thing on the screen, coming down from 20% to 10%. And this will have a significant effect on your net profit. So in our example, we're showing a margin being reduced, overheads going up, whilst the revenue stays the same, meaning a 50K loss. So as margins are squeezed, you have less gross profit to pay for overheads. And if overheads increase and sales don't increase proportionately to the increase in your overheads, your net profit will be significantly eroded and most likely end up at the loss. So if overheads go up and your revenue stays the same, profit gets eroded. So it's important to really understand, if you add a person into the business, what is the break-even value required for increased revenue to cover this cost. Now, if you want to learn more about that, there is something on our website, an Overhead is Evil or Is It webinar that I did some time ago, and it explains how to go about that. So if you were to add an estimator into your business, what is the value of sales you need to obtain to pay for the cost of that estimator? And if I think back, I think if you added an estimator in for 120 plus on costs, you would need an additional 750K in revenue to pay for that. So that's an important thing to remember when you're adding people into your business. What does great look like? So gross profit goes up from 20% to 25%. That's awesome. Overheads come down from 10 to 8, which is great. And therefore net profit goes up from 10 to 17%. That's the prize I'd be chasing. So how do you go about doing this? And I may say this a number of times today, but it is something that I always use, and it's defend and protect your margin. Ensure that you have accurate estimates and that they include all of your costs. I so often see estimates when I review them and say, well, where's the travel component? Well, where's this component? Where's that component? And they're not added in. So if you've got a cost base that's incorrect and you're adding a markup to it and not all costs are in there, you're going to erode your gross profit. So it's important to make sure estimates are accurate. So revisit these estimates during a project and on completion of a project to identify miscalculations. Now, the businesses that I see that are doing really well, they have this down pat. They do it all the time. They have a cycle, and they're making sure that their estimates are covering off things like bringing in some recovery, bringing in some contingency, and measuring if and when there are overruns from suppliers or subcontractors. So that's what great looks like. You know, a 17% net profit, that would be awesome. And it is achievable. It's not something that's not achievable. It certainly is, but it relies on this gross margin. This slide here, and I don't know if you've heard this before, but there are earners and burners. Well, that's what we call them anyway. So when we start working with clients, one of the first things that we look at is what is going into your cost of goods sold. And is everything that relates to the cost of completing a job being recorded in your cost of goods sold? If it is or it isn't, we need to determine what your true gross margin is. So what we do is we separate earners and burners. So it's important to differentiate between the roles or the functions that generate revenue directly versus those that support revenue generating activities. So one group being the earners, they live above the gross margin line. So these individuals or business activities contribute directly to making you money, like a sales team, direct labour, or subcontractors being used. They all go into COGS. The support roles live below the gross margin line in your overheads. So these roles support the revenue generating activities like admin, HR, IT people, finance people. So while they don't directly generate income, they enable the earners to function effectively. So both of these earners and burners impact the bottom line. So even though these support roles don't generate revenue, they still influence the profitability through efficiency, cost controls, and overall business operations. So it's important to know that. Now, if you've got subcontractors that are coming into the wage line, which is sitting in your overheads, then the margin you're reporting will be incorrect because they should be up into the COGS line. And what we want to determine in your business is what is your true margin. So by moving them up, your reported GP will come down. And if you do that and we get that right, then we can understand the true cost and then go back and start looking at our pricing and everything else that revolves around that. So that's your earners and your burners. Now this slide here, what margins should be. Now it's going to depend. This is what we see in the marketplace. So it's going to depend on what you do. If you're doing residential maintenance, then you could be getting anywhere between 35 and 50% gross profit. Residential new custom builds, where you're doing work inside, a custom build that might be a high-end home, for example, you're probably looking at 20 to 25. These new project builders that are out there turning over hundreds and hundreds of houses every year, then your margin gets squeezed a bit down to the 15 to 20. Commercial industrial, look, that's going to depend. I've been seeing some lately where the margins are bigger than this. They're more like 25 to 30, but it's when you're in that industrial section and it's specialized. So there's not that many people that can do what you're doing. And that might be some huge piping work inside an industrial factory. It's a reasonably sized job, but very specific, and you need to be, and you don't have a lot of competitors in that space. So that's a bit of a broad category depending on what's involved. Commercial projects, more looking like 20 to 30%. And then we see civil as probably the one that is where the lowest margins are, around the 10 to 15%. Now, we also see people that some of them do all of these things. So you're going to end up with a weighted average gross profit, and it might be 25%. But what we look at, and I'm not going to go right into budgeting, but during a budget process and picking apart your sales and COGS, we want to identify these categories that you're doing. But look, this is just a guide and some information for you, but it's quite varied depending on what it is that you do. So that's what they should look like. So what are some strategies to improve gross margin? There's a fair few. Review and adjust, optimize, increase efficiency, service mixes, etc. So these are just some suggestions, but a well-oiled machine starts with having a methodical and organized approach to pricing. So which tools are you using in your business? That's a question you should ask yourself. Focusing on margin is obviously one of the biggest levers when it comes to whether you're going to make profit out of a job. Margin will be different depending on the type of item, the scope of work, the type of client, the time frame. So many things will drive what margin you're looking for. Across the board, we think plumbing businesses should be aiming for the GP in the vicinity of 30 to 40 and overheads less than 15%. So when it comes to margin, you have to remember who you're negotiating with. And I've seen this so many times. It's so often business owners negotiate with themselves and they wind down the margin. You know, we have a saying that when you're starting out and you're having, and you have to do everything for anyone at any price. But as soon as your business starts to mature, you have to, you know, you have to back yourself. You have to get the confidence level up. You have to stop negotiating with yourself, particularly in a market like this. And I've seen it a number of times where we can take that away and build the confidence to say, no, we're not going at 12%, we're going at 25 gross margin. And what do I do in order to get that? Let's talk about our quality, our business, our reputation. Let's defend ourselves and back ourselves. So that's an important thing. Some other items here to think about include supplier prices. Are they updated? Are we talking to suppliers? You know, where we're ordering in bulk, are we able to get discounts for that? Have we asked for settlement discounts? You know, what sort of pressure are we putting on the supply chain to maintain or reduce costs? The other thing in this area is important is to know your target market. So try not to be the jack of all trades for everyone. Know your numbers and key metrics. Make sure all your vehicles, for example, are equipped with the right equipment. And I see so often that, you know, two people will jump in a car and do a run to Bunnings or Reese. You know, these are just margin killers. They're absolute time wasters. You know, there are ways to go in and around that depending on the size of your business. You know, whether they're coming to your location and you've got stock on hand and that's done every morning, or you've got a specific person that drives around and collects and distributes and does whatever. There's ways to look at that. And also capacity planning and capability planning. You know, it's important to put the right person on the right job. So let's not send someone out who's not quite skilled enough to do a particular piece of work and then takes 3 or 4 times longer than what you anticipated to in the first place. And that can be challenging with the resource challenges that we have these days, or it can be addressed by training and ensuring that they, you know, that your team is constantly going through a development process. So there's some strategies. What we're going to talk about now is just as this job costing. Now, this will relate to bigger projects that some of you might be on. But if you want to get some visibility over margins, there's this basic concept called job costing. So some people call it back costing or micro measurement. So job costing essentially is where you match invoices from suppliers and subbies to the specific job they relate to and compare the cost of the estimate so that you can see whether you're making the margin you planned on that particular job. This process also allows you to see profit across all jobs. So this is relevant to those that undertake large projects over a period of time. So for example, a supplier or contractor estimate in here is $22,000. That's what we used for the estimate. That's what we marked up. That's where we put our margin on top of. But the actual invoice came in for $27,000. So we need to be able to identify this as it's happening, and we need to ask ourselves why. So some things to consider would be, was the quote accurate in the first place? Was there an issue on site? Is there a variation that's required to go back to the client? An important control is, did you raise a purchase order for that 22,000 to hold that subcontractor to that 22,000? Are you able, or are you supposed to now be charging the client for wearing this cost? Did they make a change? Either way, you need to be asking these questions and holding people accountable, or your margin simply gets eroded. So remember, as I said before, defend and protect. You don't have enough to play with in this industry. If it's not your fault, don't accept it. Next slide. Why should you implement job costing? So staying on top of your suppliers. By matching the invoice to the estimate, you immediately reveal any variances and be able to go back to the supplier and question the charge. They might have simply made an error, or someone's added something to an invoice and it was required for the job and it's not in the estimate. So we need to know that. Overspend and overruns. So job costing will allow you to see where items and stages of a job have gone and the original versus the original estimate. So job costing will also give you an accurate read of your profit position as the job progresses. So rather than waiting right to the end and hoping that you've made a profit in your estimate, if this is happening as part of your seamless process, you'll identify it as it occurs and therefore be able to address it rather than waiting a month or two. It becomes an early warning system. So because you're keeping on top of costs as the project progresses, you have the ability to claw back profit margin on later stage through renegotiating with suppliers or your client. So that's important. Visibility of the job progress. Job costing allows you to see exactly how far through the project you are in terms of the costs that you have incurred and therefore what's left. So costs yet to spend. It makes sense that you need to be clear on what costs you've already incurred, and then you'll be able to clearly see those costs and what's still coming down the pipe. So work in progress is the last one. Look, our website has got a number of videos in and around work in progress and what that means. I'm not going into it today. It's something that would be done individually as a separate thing. But when you have jobs that run over a period of time, that's when work in progress comes into play. And that means matching revenue with expenses in the period in which it was incurred. So instead of running your financial accounts based on, oh, I spent $100,000 worth of costs here, but I didn't get the invoice out, so I lose $100,000, and then the next month I send out an invoice for 150, and the costs are already in the previous month, you end up with a P&L that looks like a stock market graph. So WIP is very important to have being done in your business should you be undertaking projects. Reducing uncertainty in pricing. Okay. Reducing the uncertainty in pricing means that the devil is in the detail. Please make sure that you clarify specifications and ensure that the actual products being quoted on meet the desired outcomes of the client. You should also make sure you understand the landscape you're potentially working in. And what I mean by that is the actual site. Can you get easy access? Are there any challenges? What will you face to get these works done as per the schedule? There are items of cost which could be incurred and should be factored into these jobs. So for project work especially, be sure to indicate how long the price is valid for and enforce it. So these quote expiry dates, we're going to get to that situation where it's an open-ended thing and we're 12 months down the track and someone accepts it and you can't get out of it. Beware of labour. So labour is always underdone. So make sure you spend time calculating this correctly. Both the amount of time it takes to do a job for projects and the hourly rate. You have to ensure this is fully loaded with leave, work cover, other entitlements. And I'll talk to that again soon with our labour calculator. And also consider fixed pricing, which we'll cover off in a few slides' time. I wanted to put all this information up there. It's a little bit wordy. I've probably got two slides that are a little bit wordy, but I think it's very appropriate. Having a good estimating process has three distinct benefits. It positions you to achieve your desired profit by ensuring all necessary costs are accounted for and accurately priced. It provides the detailed cost structure needed to track actual expenditures against your projections. And a well-composed estimate also projects a more professional approach, particularly when you're tendering for larger work. Okay, we're at margin versus markup. So this is just such a common, it's one of those fundamentals that many people still don't understand and don't want to actually admit it, or they're unaware that they're getting it wrong. So it's critical to understand the difference, otherwise you could be at risk of underpricing your items. So just remember, when you run a profit and loss, and I think I say this in a couple of slides' time, but when you run a profit and loss, there's sales, COGS, and gross profit or gross margin. It's not markup. So we report financially on gross margin. So in this example here, you can see an item costs $100. We add 50% markup. So the sale price is $150. Now, if you take that $50 difference between the item cost and divide it into the sell price of $150, you have a 33% margin. So 33.3% is what goes through your profit and loss. 50% is the markup. So in example 2, we're going to add 100% markup. So the sell price is 200. When you divide 100 into the 200, your gross margin's 50%. Now, lots of people talk markup when in fact, they think they might be operating well at 33.3% markup, but that's only 25% gross margin. And lots of estimating and lots of packages, they do work on markup, but we as financial accountants, we want to be looking at that margin. So that's the markup versus margin explanation for you. And look, these are tables. You can download this off Google. And it's a table that says down the bottom here, if you're going to mark something up by 33.3%, I'm not sure if my mouse is moving on your screen, but I am pointing. Oh, no, it's here. Sorry. Can't get. Oh, there we go. So if you're at 33.3% markup, you're going to get 25% margin. If you're using a markup of 100%, you're going to get 50. What we like to do is move the needle in this margin space. And sometimes that means that, well, not sometimes, lots of times you don't have to use a flat markup across your estimates. You can get into more detail. You might say that, we're going to buy Reese products and we're going to add 40% markup to it because we can. Or they might be small items where you're going to mark it up by 300% and get a 75% margin. And then there are other ones that are more competitive where you need to drop it. It just doesn't have to be a flat one. It's something that you should look into and say, right, how can I keep driving up my gross profit? Can I get a bit more funky around what I'm doing with my products inside my estimates? So that is a markup versus margin table. Next slide. All right. This is the labor pricing calculator we developed. So as mentioned earlier, labor is often something that's underpriced. And it's critical that you spend time making sure you get this aspect of your estimate correct. It will make or break a project. So we highly recommend you use a labor rate calculator to arrive at the hourly rate per role. And this will ensure that you're charging a rate that not only covers all of the on cost related to employing someone, and be that a subcontractor, casual worker, or apprentice, and then we can actually see the margin you're making on the various types of workers. So there are a number of these calculators around, but look, you can go to our website. It's a free tool. We've loaded it up there. Download it and use it. It's really good. So I'll just do a quick overview. But what you can see here is there's purple fields and there's blue fields. So the purple are the input fields and the blue are the calculated fields. So we are taking into consideration here the current hourly rate and then adding on top of this super, work cover, holidays, RDOs, payroll tax, if it's applicable, and so on. So the output is the cost per employed hour. So in this example, we started with 45 per hour, and after adding in the on cost, we go to $53 an hour. We then adjust the rate for the actual number of work days and hours in a year, providing a real cost per chargeable hour of $73. So with the 73 as part of the calculator, we can then add our desired margin to the real cost. Now, if you wanted to use markup, you can. If you wanted to use the margin, you can. So here, what we can see is that the charge out rate for this particular employee be $112 plus GST. Now, you can do that across each of your tradespeople at whatever level that they're at, or whether it's subcontractors or internals. This is a beautiful tool, so I would go and download it if you're interested. So fixed price models. This is something that we alluded to at the very start. So how does a fixed price model work? With predetermined pricing, the business sets fixed rates for common jobs. Example, installing a hot water system, fixing a leaking pipe, gas line installation. And prices are based on historical job cost, market rates, and business overheads. So quoting up front means customers receive a fixed quote before work begins, therefore reducing disputes and final costs. So since pricing isn't based on hours worked, the faster the job's completed, the higher the profit margin. And additionally encourage better scheduling and technician productivity. So fixed price models also allow for quicker efficiency in quoting on the spot and opportunity for upselling to clients. Just remembering, that time does kill all deals. So many of you may already do fixed price models, or you may have a mixture of different types of pricing mechanisms in your business, and that's okay. It's just something that can be implemented depending on the type of industry that you're working towards. So fixed price models, advantages. So what are some of the advantages here of a fixed price model? So jobs have a set price, making cash flow easier to forecast. Customers, they know the total cost up front, therefore eliminating any surprises. There's reduced disputes because everything's agreed up front. If jobs are completed faster than estimated, then the profit margins for you will increase. These also fixed price models make business operations more systematic. And many customers actually prefer a fixed price model over an hourly rate, therefore reducing hesitation in booking services. What are some of the challenges? So, not everything's rosy there, but there are some challenges around the fixed price models. So there is a risk of underpricing. So please make sure you take the time to ensure that all of your costs are accurately represented in your estimates. Because remember, margin goes on top, or markup goes on top of all costs. If you're leaving something out, you will underprice and you'll end up wearing it. So if jobs take longer than expected or unexpected issues arise, the business will bear that extra cost when you have fixed pricing. So be clear on the job being undertaken and ensure that the client outcomes are well understood, therefore reducing scope creep. So let's make sure we're on the same page as the client and the client gets what you're going to do for them. So we don't get this, I priced them 10 grand and the client was expecting this, and this, and it's now going to cost 12 and they're not going to pay for it because of blah, blah, blah. We want to avoid all that. So prices must also reflect market expectation whilst covering your costs. And since time efficiency drives profitability, experienced technicians who work fast are more valuable, but they can cost more and they may also be more difficult to source, especially with major infrastructure works in the pipeline at the moment around the country and certainly in Brisbane leading up to 2032 Olympics. So, you know, these highly skilled people are being absorbed into major projects. So that is a challenge to have enough resources to do the work that you're quoting for. So you also need a strong process to accurately review pricing and adjust to supplier pricing escalations. So if this is not reviewed regularly, margins will decrease and supplier prices increase. So suppliers have a tendency to do that on a regular basis. And if you're not over the top of it or you don't have a mechanism to bring supplier prices into your estimate process, then you're wearing costs and thinking that you're getting a margin that you won't be getting. So pretty important. Now, reporting pack requirements. What should you be looking at on a monthly basis? So there's a lot of financial reports that you can be looking at. You know, there's so many out there. So which ones are the best ones that can reduce stress in your life and create more certainty? Now, the ones I think about are firstly that sales pipeline. So understanding your sales pipeline. So review the number of quotes you have out there and how many of these you're winning. So that's your conversion rate. It's your early warning system for demand as well as an indicator of how your pricing is relative to the market. So if you're not using a CRM or a quoting system, I recommend you get one straight away and set up some reporting. So most of these have good reports out of the box. So the next one here is the profit and loss. So I reckon most of you in this webinar are familiar with a P&L. So make sure you understand the importance of direct costs, that is COGS, and overheads, and making sure this is actually set up properly in your financial system. We see it more often than not that it's not set up accurately. Therefore, we think we're getting something and we're actually not. So a P&L is an excellent high-level guide to show how you've performed in a set period. I know that sounds pretty simple, but we're probably all pretty familiar with that. Now, measure your budget versus your actual. So building on the P&L, an even more critical tool is your budget. So in simple terms, the P&L is a rear-looking report, whereas a budget, or as we always say, budget versus actual, shows both previous performance and what's going to happen in the future. So, and critically, it shows a comparison between how you expect it to perform, that is your forecast, against your actual performance. And if you can maintain and update your budget every month, like a rolling budget, you can start to see not only what has happened, but what's going to happen in the future. Now, at this point in time, just for an example, if we were doing a management reporting pack for a client and it was at December, we would be showing 6 months worth of actuals for December. So this is what we've done in half one. And then we go and drag the information from the budget that we established, that's probably a static one that we did earlier the previous year, and we start bringing in those budget numbers. So you got 6 months worth of actuals, 6 months worth of budget. Now we can measure if our actuals were on track with our budget. Now, if we were, you can assume that we're going to be able to hit the budget in the following 6 months. So what is that number? What does it look like? Is it 5 million, 6 million, 15 million? Could be anything. Or if we're off pace by 20%, we would want to bring down our predicted forecast budget by that 20%. Unless we magically think that we can find that 20%, but we want to be digging. We want to be looking and saying why. What was our assumption? Why didn't we get there, or why did we get there? Or are there projects that, we're budgeting for 500K in March, but we think we're going to do $1 million? So we'd want to know where we're going, because that then comes back to resource planning. I mean, you might be able to blow your budget away in the next 6 months and add an extra $1 million there, but you might need a person in order to do that. So let's factor that in. So budgets versus actuals, really important. The next one here, job by job reporting. So reviewing projects and micro measuring back to the original estimate is a fundamental requirement to eliminate errors and to find those 1% gains. We talk about the 1%ers all the time. Appropriate detailed reporting by job is a necessity for those of you doing extended and major projects. So that micro measurement, job by job, where are we winning? Where are we losing? Do we need to make changes? So we need to get clarity on whether our pricing is working for us. So it's important to have a regular feedback loop discussing all of these elements that are shown on this slide. And that's what a specialist CFO would do for you. These are the types of things we want to look at monthly, and we want to investigate, and we want to make decisions. We want to understand what our assumptions were, and we want to take into account the future forecast, what's happening in the market, what challenges we're facing. I mean, simply out of some of these, we might be behind on revenue, and we go, okay, we're going to spend $5,000 a month, and we're going to do Facebook, Insta advertising, or we're going to do Google AdWords. What are those AdWords? And then let's measure. If we're getting hits and we're getting leads, and it's bringing in $5,000, bringing in an extra $150,000 a month, then it's probably worth it. But we need to have those discussions. We need to create that loop of information going around and start stripping that out and pulling that out and saying, this is what this means. Here's a strategy here. Here's this. Here's that. So the feedback loop and the reporting pack requirements, that's what I would be looking for in your business. Ideal metrics. Look, there's so many metrics. What are the ideal ones? Well, there's some really simple ones, and it's important that, the ones that are important to me need to be important to you. So simply, what is your gross profit? No, not the dollar number. What's the percentage? Is it 30%? Is it 40%? What's your net profit percentage? Oh yeah, I'm getting 6. Well, we want to get to 15. We want to get to 10. Or are we going to stay at 6 because we're turning over a large amount and I'm comfortable with 6 and it's delivering $1 million and, I'm okay with this, that. So what are your goals? what is the GP, what is the net profit. So other metrics include does your current ratio stack up? And that's simply, do you have more assets than liabilities? Now, we know everyone would be familiar with, obviously, the QBC requirements, MFRs and NTAs and everything else that goes with it. So you need to know your current ratio number, and you need to be able to, especially in a forecasted financial reporting pack, know if you're on track to be able to hit your license requirements. Some of you, what are your accounts receivable days? So it just depends whether you're on which clients that you're dealing with. It'll differ by industry. If it's residential maintenance, then there'd be no outstanding debt. People are paying as it's completed. But if you do have clients with agreed terms, whether that be through tenders or contracts or whatever it is, you do want to know your accounts receivable days, and that is how long does it take for your clients to pay you. Now, you don't want that really going out over 45 days, but again, there could be issues, disputes, there could be things that need to be fixed, go back, reworks, whatever it is. But it's important to have them as low as possible. Another one that would be interesting is to identify your technician utilization rate. By technician, I mean, who plumbers inside your business, or you may have other, have diversified slightly, and there are other trades where you do a multiple of different things. But what's their utilization rate? How do you compare that? By looking at your whole team. You might have one guy operates at 90%, another guy operates at 75%. Then I wouldn't mind knowing why. Why is that the case? Because again, if we look at that, go back to that labour price calculator, there is a utilisation number in there. Now, I think it's 89% or 90%. I mean, people aren't going to work 100% of a day at 100% of the time on stuff. They're going to have breaks. They're going to do this. It's going to happen. So your utilisation comes down. But if that's the case, then your cost, as utilisation comes down, your cost goes up. So I would like to see what is the utilisation rate of all of these people. And if I've got a job and it's going over here and I'm giving it to Bill or Ben or whoever, maybe I need to increase the margin on that. What is the quote conversion rate? So this one's important in terms of how many quotes you do a month. So if you do 20 quotes in a month and you win 5 of them, your quote conversion rate's 25%. Now, I would like to see, I would benchmark, a minimum conversion rate of 30%. And you mightn't be able to get there. There may be challenges for that, but look, there's a little, it depends again on who you're dealing with and where these quotes are coming from and whether the leads are quality. I mean, there's no point in having this funnel of leads that's this wide, and then out the bottom you end up getting 1 or 2 or 3. Obviously, what's coming in the top is not ideal because there's not enough scrutiny in and around these sorts of things. You might have an inquiry, contact us on your page, and you're getting 100 of these contact us, but you're not really getting that much work out of them because maybe there needs to be some further questions. Are you ready to do this now? Do you need financing to make these things happen? Questions like that start to just really polish the lead funnel, because if you've got too many, your conversion rate's going to be very, very low, and it's very time consuming and time wasting. So something you should know, what is that rate? So in addition, down the bottom here, look, I could have put a number of metrics there in around debt and assets and return on investment and so on, but I wanted to just keep it I just wanted to change the dynamic here slightly. So in addition to these metrics, I advise clients to build a 3-month cash war chest. So the idea of that is that, if there are health scares that go on like COVID did, or there's flooding, or there's serious weather events that occur, if there's a downturn economically, if there's an upcoming election and severe uncertainty and approvals die off or whatever, you want to be building a war chest at some stage. And it can be as simple as just opening another account online, and you dump $5,000 a month in there and you just don't touch it. So it's not your GST and your BAS and your PAYG and your super, that's all coming out of your normal cash flow, but you're just putting 5 aside. You're just putting 10 aside, or whenever you get a chance, and you build a bit of a war chest, because that's going to help you sleep at night when it comes to events that are outside of your control. So rather than go through all of the balance sheet and give you percentages, part of that balance sheet is the cash at bank. And I think that lots of people need to start building war chests. Not to say you can't take money out of that war chest at some stage, but, as it keeps building, it's certainly going to help you sleep at night. Let's dive a little bit deeper into our metrics. So I don't want to go into too much detail here because, again, as I said, there's so many, but I like to talk to clients about break-even point. And the break-even point is the cost of running your business divided by the margin equals the number of sales you need to have a 0 net profit. So that is your break-even point. Accounts payable days, how long does it take you to pay your suppliers? Now, most people try to keep their suppliers and their contractors extremely happy, and they pay them very promptly. But I can say to you, if your debtor days were 45 and your accounts payable days was 15, you've got to fund 30 days of working capital. Again, it depends on the size of your business and where your revenue is coming from. So without going into too much detail, AR and AP, we look at both of those. What else have we got here? Marketing return on investment. So really, if we're going to spend, and sometimes it's challenging, especially if you don't have a CRM. I'm going to spend $5,000 doing, I'm going to spend $10,000 doing a new website. How am I really going to know what I get from that? So you need to have a contact us page, or you've got a calculator on there that someone can download, or there is a request for a quote, whatever it is. We then go, right, this cost us, this is the amount of leads we're coming in. It's a lot easier to measure a Google AdWords or an Instagram or a Facebook campaign of money spent versus leads coming in, and then leads that were won, and then profit out of that job, and then go back and measure against the actual spend. So we talk to clients about that. What's the next one? Equipment utilization rate. So it just depends whether you're hiring equipment, or you've bought equipment. You might have bought an excavator and you did it for a particular job, and you got, that job went well, blah, blah, blah. But is it being utilized? What's the future look like for it? Is it then going to sit around idle? What's going to happen with that particular piece of equipment? Again, depending on size and the type of item that you're doing, you want to understand your utilization rates. And then whether you can subcontract it out to someone else as a dry hire. So all opportunities there. So bookkeeping. Just going off on a slight tangent here, but this sounds really mundane, but so much of your financial clarity relies on your bookkeeping. So how accurate is this? How timely is it? How are you entering it into your accounting software? So this is the foundation you're laying for whether you'll be able to actually see what's going on in your business. So you get this wrong and you'll be flying blind, or even worse, making poor decisions because of either a lack of data or dodgy data. As the saying goes, garbage in equals garbage out. So some actions and insights. When you're scaling up a business, the complexity increases exponentially. To stay on top of all the moving parts, you must have strong financial visibility. And the bedrock of this is your bookkeeping system and processes. With a well-oiled BK machine, you'll be able to trust your data and run and be able to see the financial health of each project and your whole business. The following is a full breakdown of the key things to consider when leveling up BK in your business. So you need to have an appropriate financial reporting system, i.e. Xero. You need to be able to capture invoices and receipts. Use a program like Dext to do that. Implement an appropriate estimating and job management software like BuildExact or BuilderTrend or Wonderbill. Utilize Deputy or Xero.me for timesheet recording. Utilize cloud services is the last one down here, which just, there's so many platforms on cloud services, and it gives you the ability to streamline your processes, whatever you're looking into, boost access from everyone, and give you the visibility and unlock the full potential of your business. So I think it's important to consider that you've got the right software stack in your business. Now we're almost there. So a couple more slides. Actions, putting the theory into practice. So you've now got a good process in place for pricing. You got good bookkeeping. You got good data. You've turned your data into a commercial reporting pack. Now the most important piece, doing all of this will go a long way to removing uncertainty and giving you financial clarity. But don't stop there. What's the use of having clarity and not putting things into action? Actions and insights. All right. So from your reporting pack, you can now see that your scorecard and see what's coming down the road and start to get a real picture of the story of your business. In terms of translating this into action, here are some examples. Identify job over and unders. So if you have bleeders, what do you do? If you have overruns, what do you do? Is there wrong pricing, an incorrect estimate, poor contractor service, or material shortages, delays? What are these overs and unders? Know what they are, find out about them, manage them, deal with them. So be aware of upcoming cash flows. So how are project claims landing for short-term projects? It looks like in a few months' time, you're going to have a real dip in cash coming into the business. Can you move claims? Do you need to land another short-term project? Or do you have to bring something forward? Or maybe you need an overdraft to bridge the gap. You have to be aware of the forecast and what's going to be a problem. And as we know, December, January, February, it's challenging, always. So make sure we can understand that. Ensure that you look at your capacity and resources. So can you see if you can continue to grow at the rate you are? And are you going to have to put more staff on? But if you do, what does that mean in terms of your profit? I need an estimator. All right. Well, I need to find another 750 grand in revenue. Can I do that? If not, I have to wear that cost in my business and I'm not getting enough revenue to pay for that. Therefore, my net profit will decline. Do I have enough net profit? If you don't, you really have to think about whether the estimator is going to be the right course of action. So estimates, they must be accurate. Critical component. All costs need to be included. Overheads can be recovered. Contingency can be included. And are my margins appropriate for future goals? And do I need to vary my margin across products so that I can get more overall margin? Might take a little bit more work, but something I'd be doing. And finally, are all my supplier prices accurate and updated? Have I thought about all the costs that relate to a particular job? Have I allowed enough margin should something go astray? And then, sorry, I've slipped up. Total costs, accurate pricing. Yeah, which I've just covered off. Let's make sure we've got all of our costs in there. And then when we go to markup, we're marking up on all costs, not 3/4 of them. So last slide is going to talk about an action list and accountability partner. So now that you've got clarity, you can see what's coming and have a good idea of what you're going to have to do. So where does insight go? Are you going to let it float in your head, keep you awake at night? Or are you going to add it to your action list? So I don't care what format you actually use, whether it's a spreadsheet, a Word doc, Trello, Asana, whatever you do, just make sure you have a system to capture the insights and the action you want to take. Then do a regular review. Hold yourself accountable. Accountability partner. So running a business can be a learning exercise at times. It's also easy to let yourself off the hook. So a solution to consider for this is getting someone outside the business to be your running mate, like someone from CFO Advisory, where you share your reporting and your actions with them. Talk through these and where the business is at and where it's heading. We find in the work that we do in this space that sometimes this is about having just another set of eyes to come up with a solution. But a lot of the time, it's about having a set of ears that are listening. And then you've got someone that you're trying to work something through with. Then we keep each other accountable and reminding us of what the goal is and the size of the prize. So that is, if I look here, we've come to the end of the presentation. So look, there's a lot for you to absorb here. So, feel free to reach back out to me should you need further clarity on any of the items presented today. So there's a lot in there. So I guess the last thing here, Tracy, is that we go to our question section.
Yes.
And whether or not we have anyone that wants to raise any questions. Otherwise, look, you can, if you don't want to do it in this forum, just email me directly and I'll organise a time to catch up with you and work through some of this stuff, because technically it can be, some of these areas can be very challenging. So, but that's our expertise. So that's it from me, guys. I hope you enjoyed the presentation.
Thank you, Gregory, for your informative presentation. Does anybody at all have any questions? No, that's okay. Well, we'll get Greg's contact details for you all, and
Yeah.
if you have any further questions, you can make contact with Gregory yourselves.
Yeah. Yeah.
All right. Well, that's probably all we have time for today. Thank you again to each of you for joining us today. Thank you to Gregory for your presentation and taking the time to be with us today. Thank you, everyone.